Hi, everyone. This is Jason Bjork of Wall Street from East Street. Welcome back for another Wall Street from East Street podcast interview. Today's special guest is a returning guest. He writes the paid newsletter over Capitalist Exploits. He's a hedge fund manager. In the past, his resume included working at top-tier investment banks, and he was a technology company venture capitalist. Chris MacIntosh of Capitalist Exploits. Thank you for joining me.
Pleasure to be back, mate. How are you?
I'm hanging in there. It's wild and wacky as normal here with the crazy policies. And of course, right outside of Washington, D.C., it's nonstop election talk. I am so sick of it, Chris, of all the lies and the corruption.
What a time to be alive, man. We are, Jason, at the period of time where maps get redrawn and everything changes. And I say that because if you look at historical trends and cycles, we're bang on due for this. And so it shouldn't sort of be a surprise. And that being said, we've been talking about this for a number of years, and still every day I wake up and I'm like, really? I see something else that's like completely batshit crazy. And then I have to remind myself, yep, no, this is where we're at. This is actually on a historical, time frame. This is actually normal. Like, this is to be expected. So anyway, why don't we talk about that and all the implications for various asset classes and even jurisdictions and so on and so forth? Because it's a wild time and risk is in the air. But at the same time, I don't think we can actually watch the capital shifting in real time.
So we're recording this interview on Tuesday, August 27th, 2024. The gold price is well above $2,500 an ounce. It briefly drops below 25, and then there's a huge bid coming in. Seems like the last couple months, there's large bids coming in, anything below 2,500, especially physical demand from the non-G7 central banks and the Asian retail investor, China, India, Asia, Japan, Korea. And the 10-year US Treasury yield has dove recently, but it's been a roller coaster the last 9 to 12 months. It's down to a little above 3.8% when we're recording this interview. Chris, I want to get your thoughts on these leverage trades that these banks and hedge funds are doing, this yen carry trade unwind that supposedly is over, according to JP Morgan. They're claiming that the yen carry trade unwind is 75% done. Do you think that that's true?
I don't know necessarily enough about that. But that being said, I think that I don't see that as being as big a risk as the markets are making, or as people are making it out to be. And there's a simple sort of reason behind that. The entire reason for the deflation that we had in Japan for decades and decades had very little to do with Japan itself. It had to do with the broader international environment in which Japan was pursuing those low interest rate policies. And what I mean by that is, being a net creditor nation, they could continue to weaken, or at least to have and sustain very, very low interest levels. Of course, they manipulated and completely destroyed their bond market in the process, whereby it's not a free market. There is no active bidding and offering on JGBs. But they could do all of that because you had this broad international setup whereby bonds were all on the same path. They were all headed higher with interest rates lower. And that pursued for decades and decades. In that environment, it didn't matter so much that Japan had debt to GDP levels that make blood shoot from your eyes, right? However, that's all changed. And so now we're in a different environment whereby interest rates have been rising external to Japan. They, on the other hand, don't have the ability to follow that market. They have such high debt levels that a fairly small interest rate increase in their bond market basically overwhelms their ability to service it, and so the government just goes bankrupt, and they're quite aware of that. So that's the basic environment that we're in. So they were kind of stuck with a couple of problems. They they can't raise interest rates in any meaningful fashion, not without bankrupting themselves. They have massive treasury hoards, which they could sell into the market in order to suppress the fall in the Japanese yen. which is why the little midget was over there about 4 months ago, likely 3, 4 months ago,
You mean
telling
Yellen,
them,
right?
yeah, yeah, exactly. Um, and so that was almost certainly why she was over there saying, "You look, we know that we're raising rates, and we know that it's hurting you guys, and your inflation's kicking in, and we also know that you're a net importer of energy as a nation, and that's your Achilles heel, and this is now going to begin hurting you. But don't you dare, basically." So the only other ability that they had to deal with this problem is to raise rates. And again, they have a very, very tight window. They don't have a real lot of wiggle room there. And so the market didn't anticipate that they were going to do that. And as a consequence, they were prepared to go out and borrow yen and take long trades on almost anything, because you had not just substantially lower interest rate costs. I mean, you could basically go and toss it into treasuries, borrow it like roughly half a point, and go and throw it into treasuries at roughly 5, and basically earn the spread. And then, of course, if you did that with any level of leverage, you could get rich pretty quickly. So, and it wasn't that necessarily everybody was going to treasuries, although that was a decent portion of the market. There's a lot of it's also been going into things like the Mag 7, because why would you throw it into something at a 5 point differential when you could take a little bit more risk and throw it into the Mag 7, which has just been screaming higher, and get 10 or 15 or something else. Anyway, so that was the trade that was put on based on the assumption that the interest rates couldn't be raised in Japan by the Bank of Japan. And so they surprised everybody by going and raising. But the reason that I'm not that I don't think it's ultimately that big an issue is because they can't actually raise very much. They're like, as soon as they hit about 80 bips, they're done, right? So, I mean, fine, they could raise a little bit, but ultimately, if they raised to the point that they need to raise, in other words, to get it to equate to similar bond markets like the US, they're dead, right? So we know that they can't. They can only take it up by like probably 50, 80 bips at this point. So if you can basically structure your trade around that and say, well, you know what? I can just account for that as a risk variable, where if interest rate is X and I'm investing it at Y, what does it look like? Now, the only other issue that I've got is currency risk, in that the volatility could wipe me out. And that's basically what we saw. I don't think that a lot of the unwind of that trade had very much to do with the variable in interest rates, i.e. the Bank of Japan raising and having that crush their profits. It was just the fact that the Bank of Japan raised, which then had the yen go higher. And there was a brief unwind of that position where people were like, holy shit, I didn't think they'd do that. And so the market kind of freaked out and unwound those positions. But it basically bounced back, and it's going to bounce back because, like I said, there is an inability of the Bank of Japan to raise rates to any level that's meaningful and anywhere near that which is found elsewhere outside of Japan, i.e. in the UK, Europe, and the US in particular. So that's kind of, we're stuck with that. And I think basically you just kind of continue to, over time, continue to see the yen slide, because they don't have any ability to do anything else. They're not going to go and dump their treasuries. Why? Because on a geopolitical basis, they're surrounded by China and the massive influence there, who are not really their friends. And they're very reliant on the US military in that respect. So they're not going to go and take that risk. So I think Japan just keeps weakening the yen, and I don't really see that trade unwinding. It's going to unwind in a different fashion, i.e., just in the yen getting smashed. So that's that side of things. I mean, there's a bunch of other weird ass trades going on, but with respect to Japan, it's. I think that was more like a speed bump on a downhill run, and it caught people by surprise. But if you look at the structure of what is possible and what's available in terms of tools by the monetary authorities, they're screwed. There's nothing they can do at this point.
And I think the Bank of Japan has spent $100 billion or over $100 billion already trying to defend their currency exchange rate, and maybe it's helped for all of a couple weeks, so it hasn't really helped. And
Exactly.
yeah, so they've wasted all their an insane amount of foreign exchange reserves. Chris, you said that they could protect their currency by raising rates, but they can't. I mean, in the past, countries and central banks, they used to buy gold tonnage to protect their currency, but apparently Japan, since they're in the G7 and they're a vassal state post World War II, they're afraid of the political people, the policymakers here in Washington, D.C., putting sanctions on them, so they won't be buying gold tonnage, I guess.
Nope. Nope. And it's too late. I frankly think it's too late. They needed to be going and taking their treasury hoards. Because look, remember here's the thing. Japanese companies are still incredibly profitable because some of the like world leaders there, and they're um they're printing money. I mean, these are very profitable, well-run companies, building up very strong balance sheets and so on and so forth. That's at the corporate level. But even, you know, they should have been taking those assets and doing what China's done for the last 15 years and going and putting them into hard assets. But like we don't actually know, for example, with China, how much gold they have. I saw a report out by the I think it was the World Gold Council, just maybe last week, with respect to various countries and who's buying gold and so on and so forth. And they've kind of got central bank holdings, and the US is way ahead, and then China's sort of behind it. But the reality is that no one actually knows what China owns. We know that they don't export any of their gold, so they keep everything that they make, and the numbers behind that they aren't very open with. And yeah, no one actually knows how much gold the Chinese have. That's one thing. The second is that, I mean, you can see in treasury purchases over time, basically where they're no longer buying US Treasuries at the rapid clip that they were 20 years ago, and they're putting it into other assets. Now, a lot of it's gone into mines in Africa and Southeast Asia, and ports and infrastructure and all those sorts of things. But there's also a good argument to be made that a bunch of it's also gone into gold. Japan hasn't done that. Japan's just been building up bloody treasuries. And so now they've basically got this so-called wealth sitting there, but it's a wealth that they can't touch because it's actually a geopolitical question now. As soon as they start dumping those, then the US has the ability to say, well, maybe we don't protect your military, maybe we don't protect your country, kind of thing. I think ultimately there's an inability for the US to do that. They can't fight so many wars, and they're trying to attack Russia, and they're trying to attack Iran, and you name it. So anyway, here we are. But Japan's in a tricky situation. They don't have the ability to really do anything at this point. And I mean, diplomatically, it would be, if it was me put in charge, I'd diplomatically go and start changing course with respect to basically the countries that I'm surrounded by, and making friends, basically, because that's just the reality of the situation in. Anyway, but I don't really see that on the horizon, so it's a problem.
You mentioned like the Japanese technology companies and the industrial companies. I think those companies are sound, but I think there are risks to Japanese companies like SoftBank. I think SoftBank, and you've talked about this in prior interviews, you had experience investing alongside SoftBank in technology companies, some of those Silicon Valley tech companies. I think SoftBank even got very heavily involved in Silicon Valley and San Francisco commercial real estate. So they were buying the office buildings that those unprofitable tech companies that were raising investor capital were paying exorbitantly high rent. So SoftBank ended up buying a lot of those buildings. I don't think they've written off the losses. And those private Japanese banks, Chris, like a Norinchukin Bank, they have massive losses on U.S. commercial real estate and also older U.S. Treasury bonds too. So I think there are risks in the Japanese economy. It's just like in the banking sector because of exposure to the U.S. assets like commercial real estate and older Treasury bond losses.
100%. I mean, I don't think like when you think about SoftBank, it's basically a Western company, in that the vast majority of the aside from owning, excuse me, a whole lot of uh, Japanese debt, it's it's a tech company, and it's been investing into, as you mentioned, a lot of stuff in Silicon Valley. No, I mean, you do need to be very careful around where you, like, what sectors you invest into, and this is true of every market. But if you look in like the big industrial trading houses in Japan, those things are they're fine. And so, you know, that's where I'd focus on, because again, they're a lot of those companies are international in scope. Like they're manufacturing sometimes certain things in Japan, but you're looking at companies that are operating globally. So those are what's interesting. And basically, the baby's got thrown out with the bathwater. Everyone goes, "Oh, Japan's crappy. Equity markets are shitty," and they just discount them. Um, I mean, some years back, I remember saying to a trading partner, "Yeah, well, look, if if I was doing a different job, I'd basically go and take a lot of these companies that are Japanese trading houses. I'd rebrand them potentially, and basically do a whole marketing blitz, and then go and relist them on an exchange in, say, North America, um, because they're tainted with the whole you're Japanese sort of painted with that brush, and so no one really looks at them. And this is back when Buffett was started buying these things along with us. So anyway, but yeah, you got to be very careful about sectors, and that's what we talked about just before we jumped on and started recording this. There's going to be, I think, a massive continued supply constraints across the commodity spectrum. We were just talking about Mexico and the insanity that's going on there with Obrador, who's basically paving the way for a communist, complete totalitarian system for Shinbom, which is kind of a bit alarming. But it means that if you're going to be investing into or let's put it this way, where is the supply going to come from for things like copper and silver and gold and all these things? Many of the places that we had considered or where they came from before are politically very different places now. And almost every single one of them is worse.
Oh, yeah, I agree.
Has higher risk.
Especially the elections the last 6 to 12 months in like Colombia, Mexico. Look at what happened to Cobre Panama, that giant copper mine. I think it's over 1% of the annual copper production for the entire globe out of Panama, and that mine shut down. It'll probably restart, but I mean, like Franco-Nevada shares and the copper miner have gotten whacked for the last 12 months or so because of that.
Yeah, exactly. I mean, that's you could, there's a few bright spots. Obviously, Argentina is rocking ahead, and things are going in the opposite direction there. But it's like there's broadly you've got. I would say I haven't looked, I haven't done any statistical analysis on this, but as a rule of thumb, based on looking at the shit every day, I would say probably 60 to 70%, maybe 60% of the world is with respect to commodities and mining, is in a worse geopolitical setup than it was even just 5-10 years ago. And that's causing more uncertainty. And as you'd know, in the commodity space, these are very capital intensive types of businesses. And they're also long cycle assets. And what I mean by that is when you're going to build a mine or operate a mine, your investment into the expanding operations or even developing operations has a payoff time frame in the multi-year, sometimes multi-decade time frame. Okay, so what you actually need in order to safely deploy capital is some level of certainty. Okay, you need certain. Excuse me, getting a cold. I think you need certainty with respect to interest rates, right? Which we don't have. And you need certainty with respect to political outcomes, which we absolutely don't have. And so what happens is that your capital providers hold off and they go, well, I know it's profitable, but geez, what's Shinbom going to do in Mexico? Or, what's going to happen with that mine in Colombia? Or, there's just this very uncertain environment. And as a consequence, they hold back in deploying capital. And so we're seeing that across the board. And as a consequence, you just don't have the supply coming through. And remember, all of these markets, all of these commodities, they're all depleting assets. It's not like we're chewing the shit up every day. And so that's the environment that we're in today, which is already leading to, and I think will continue to lead to, supply constraints across the commodity spectrum. Some are more important, in my view, than others, or more asymmetric, shall we say. I would suggest probably mostly in the energy space, but aside from that, there are significant problems. And over the course of the next 5 to 10 years, we're going to see some really violent moves in the underlying spot prices of a lot of these assets. And the ability to actually correct that only ever comes from additional supply. The governments are going to try all sorts of stupid things. No doubt they will put in, oh gosh, I think we're going to have shortages that lead to price controls that also then lead to rationing, things of that nature. It's a very precarious situation, but it's the only way that we as investors can actually mitigate that is to understand the underlying market, why the probabilities are what I say they are, and then to position yourself and just ride the volatility, because we are going to have some seriously wild volatility. I mean, we've been watching it. This year has done that to our portfolio. I mean, we've had, gosh, sort of 20% swings, it's not that unusual for us, but it's pretty, it's been in a very short time frame.
Yeah, I mean, uranium has been a star the last couple of years. I was writing articles about Cameco in 2020, 2021, 2022. No one wanted to buy Cameco shares back then. Now you're starting to see that there's going to be additional nuclear power plants built in the years to come out of China and India because their permitting process is accelerated. And then on top of that, the world's largest uranium producer is Kazatomprom in Kazakhstan. I think they just issued new production guidance. They said that their supply production for 2025 is going to be down at least 17%. So they're not hitting the numbers. And it's the same story for a lot of these key metals too, Chris, whether it's copper or silver in a lot of the largest producing country for these metals like Chile and Mexico and Peru.
You just nailed it. You just nailed it. And I mean, the Kazatomprom thing is a little bit unique. I mean, they had a number of projects in play which have had issues, shall we say. One of the issues was that a couple of the Russian billionaires that owned stock sold it. And anyway, there's been we can get into it. But again, supply constraints. They have an inability to bring on the supply that the market was pricing. As you said, 17%. There's numbers that have been thrown out around sort of 25%. But that on the back of the fact that I think there's 5 new permits that have just come through for nuclear reactors in China. India's got a whole bunch coming through. Russia's got more coming through. And, the question is, well, where are we going to get the supply? And there's been, no one really knows. That's in the uranium space. And so the pullback that we've had now in the last couple of months, I think is a great opportunity for people. From my perspective, we're just riding the volatility. I mean, we got invested into that sector way back in sort of 18, 19. So it's it's been very profitable for us, and we're going to just continue to ride the volatility. We'll change those positions only when the fundamentals change, and the fundamentals just keep getting better. So, but we're seeing the same thing across the copper space. We're seeing the same thing, especially across the energy space in things like drillers and that. I mean, gosh, there's just with no real supply, and then you can go all the way down sort of through the supply chain. Tankers.
Oh yeah, did you see coal demand hit an all-time high in 2023 at the end of 2023 because of demand increases for coal-fired electricity from China, India, and other parts of Asia? So they're still building coal-fired power plants and all those and importing coal, and yet you have the Davos crowd trying to throw hundreds of billions of dollars at the energy spending grift, solar, wind, biofuels, electric vehicles, almost all the electric vehicle companies, Chris, are either close to bankruptcy or about to file for bankruptcy.
I love it. I just the when was it? I think it was yesterday. Ford, yeah. Ford just took they just took I think a two or 1.9 billion dollar write-off. And they're scrapping all their plans for electric vehicles. But this is on the back of most every major auto company is doing the same thing. And we wrote about this 3 years ago, saying that auto companies are going to have huge problems here. And it just took a little bit longer than we expected, but nobody wants this shit. It doesn't work. It's expensive. It's actually harder on the road, electric vehicles, and now here's the other thing: you're going into an environment where you're trying to build electric vehicles, and your grid capacity can't handle it. Not only that, not like in terms of additional electric vehicles on the road. Not only can the grid capacity not handle it, the grid's falling apart in many Western countries. And then what supplies the grid, they've been destroying. So natural gas has been a big one that's been under pressure, not in North America, but outside of North America. Of course, if you look at Europe, they blew up the Nord Stream. And so now you get all these, with a power station, you can't, for example, just say, okay, we don't have any natural gas, let's use oil. You can't use oil in it. The only other substitute typically is coal. And so now we've seen coal imports screaming higher in Europe, screaming higher even in places like New Zealand. And then we look at China, which has got domestic coal productions down. And it's like, where's it going to come from? So the coal mining companies have been very volatile, but man, they've been profitable for us. And I think this is going to be one of the biggest challenges for many investors is to be investing and understanding the fundamentals behind these markets, because they'll go in. Like coal, like we started buying this back in 20, I think it was about sort of 19, 20. And in a heartbeat, a lot of these things are up 2, 3, 4 times. But if you understand that there's no additional supply coming, or not on a relative basis, then like who cares? You just keep holding it. And the fact is, a lot of these things are still really cheap. I mean, Peabody's trading, I think, about like a P of like 6. And you know, um,
Don't a lot of these pension funds and like bank portfolio managers that buy the shares, they're not allowed, the institutional investors are not allowed to buy some of these fossil fuel companies because they have ESG bylaws in place. So they're not allowed to buy oil companies or natural gas or coal miners.
No, I know. Yeah, I've written about it heaps. I mean, I just laugh at these woke, spineless Wall Street crowd. I'm like, you guys are awesome. I love them, because what they can't do is have a spine. And so for guys like me, I'm like, this is awesome. I just don't have any competition. We were buying coal mining companies at like 2 to 3 times PE with 15% dividend yields. I'm like, I'm like, what's wrong with you guys on Wall Street? Oh no, we can't touch that. It's not ESG compliant. I'm like, great. Keep it on the way.
Yeah, they have to buy all the electric vehicle manufacturers, and then like a year or two later, after the pump and dump from the Department of Energy contracts that are unbidded, then the shares crash.
Exactly. I'm like, you guys are complete monkeys. You're gonna get what you deserve. And but that's an opportunity for forgetting about me, like for your listeners. This is a huge opportunity to be able to invest, because as a retail investor, you don't have to care. You don't have any ESG policies. You don't have to worry if the CEO doesn't have a transgender on the board or whatever. You can do whatever you damn well please. And I would suggest that you do, because that's where the asymmetry lies.
Yeah, I agree. Even like Newmont Mining has a lot of vice presidents like for ESG and DEI and stuff like that. So I mean it's just getting out of hand in all these large companies. Like why did they need all these vice presidents making hundreds of thousands of dollars a year for compliance?
Exactly. Yeah, diversity hires. No, it's sad. I mean, it's basically, and you get this gets back to the point that we were talking about at the beginning here with respect to geographies and jurisdictions. This is a Western phenomenon. This whole DEI nonsense. And so, when you contrast companies that you might want to own, it's worth thinking about that. Now, I'm not saying don't own Newmont or Barrick or, you know, any
There
of
are probably
these.
trades. Look at Druckenmiller. I mean, Druckenmiller is already doing well with those.
Yeah, they're great trades. I'm just saying that, there's a lot of other opportunities out there. See, here's another thing with a guy like Druck, or even certainly with any of the larger funds out there. They can't buy a lot of the things that we buy or that retail investors can buy for the simple fact that the markets have been so decimated that now the market caps on many of these companies are sub $1 billion. And so I don't know how much Druck is managing, but it's substantially more than we manage, I'm sure. Um, and so, like if you're a multi-billion dollar fund, you can't go out there and buy a company that's a 800 mil market cap. Like, what are you going to do? 1%, half a percent? Like it just, they're too small for you to touch. Um, and and so that's great.
It won't move the
That's
needle. It won't move the needle. Look at Buffett. I mean, Buffett was for decades, Buffett only bought small caps and he was compounding his returns, what, at 20 to 30% per year over his long career. At the beginning, he was buying a lot of small caps.
Yeah, and like here's the other thing that I would just point out. You don't need to have the equity price revalue on a lot of these things. You'll buy, like, okay, so think about some of the tanker stocks we've been buying. I'm just using this as an example. You have the companies paying out double-digit dividend yields. You could have the thing trade sideways for years. If you're compounding at 12, 13, 10, 15% on an equity base, which is cheap anyway, like, why wouldn't you? Right? It's just like it boggles my mind. But people get fixated on the equity price. Um, and and so they're like, oh, well, I bought it for $1 and it's still trading at $1. I'm like, well, if you're getting a 10% dividend yield year over year and you're compounding it, what was it Einstein who said the most powerful thing in the world was compound interest? I mean, it's stunning. It goes back to the story that I've been mentioning. My analogy for coal mining companies was tobacco. Tobacco was the best industry to buy basically in the 90s when they started sanctioning tobacco companies from marketing. And what it did was it just created a moat around the existing players. And so if you compounded your dividends on tobacco stocks, it was the best performing sector to be invested into for 20 plus years. Better than tech, better than all these things. People would have gone, oh, I should have bought Apple. No, you should have bought stinky old tobacco stocks because that was the best sector. Anyway, so I think we're in a similar situation with respect to some of these dividend paying stocks. I talk about coal is a perfect example of that, but there are others as well.
I think
And
what
again, a
people
lot
don't
of them are
understand.
small caps or
So
medium caps.
So those dividend yields that you're talking about, I mean, what the average person doesn't understand for the first couple of years, a 10% return might not seem too much, but over longer periods of time, your nest
You're
egg, your
compounding.
total capital, yes, it will compound.
Mm.
So
Hmm.
your the size of your share position, if it's paying out what an 8% dividend yield or higher with those tobacco stocks, I mean, your total capital could double over a short amount of time, 10 years or less.
And the other thing behind it is that you don't actually increase risk. So think about it like this. Let's say you got a stock that's trading at a PE of 3, okay? And it's paying, and I'm using this example because this is one of the stocks that we bought, paying 15% dividend yield, okay? So you come in year one and you buy the thing, you get 15% return. Cool, happy days. Wonderful. Now you're taking that 15% and you're adding it to your base, right? So you start off with $100, you got 115. Now, if, for example, the stock had gone up 15%, okay? and your PE was no longer 3, but it was like 3.5 or 4 or something, right? You're actually got a riskier position now. It's not as cheap as it was. Now you're going to year 2. Let's say you get another 15% return. And if it's not a dividend, let's say it's an equity return, right? Your PE now goes to 6 or some other number, right? It's gotten more expensive. In fact, it's twice as expensive as it was when you first bought it, right? So you're increasing risk where your equity cost is higher. On the other hand, if you're getting a dividend and it's not changing the PE, well, like you're still got the same risk profile and you've just compounded 15%, another 15%, another 15%. So you still have all the equity upside that can come, and it ultimately does come over time, especially when markets, look, these markets they will correct in time as money. People always chase money. At the moment, they're running around saying, oh, Greta doesn't like us buying coal stocks. And, they got all of the ESG policies and all of this political narrative. But money will go where it's treated best. And over time, you're going to have, we're seeing like the Chinese, they're just going to be, sucking up all of the bloody market share on these things.
Well, the other issue,
and it gives them political power as well. You're going to have capital go, okay, well, I guess we're going to go in there then because that's where we're going to make money. And so it'll shift back towards coal. And to some extent, Jason, we're actually watching some of this transpire at a political level within the West. So you think about nuclear, right, which we talked about. Now, there was a long period of time whereby if you couldn't say anything positive about nuclear. And now we got a lot of these woke, blue-haired, freaking nose-pierced morons coming out saying, well, it's kind of like renewable, right? They're basically not, they will refuse to acknowledge that they were wrong about it. So they basically try and rebrand it, right? So they'll rebrand stuff and say, well, that's actually renewable. So we can now use nuclear. And as an aside, there was just to highlight the point. One of my staff sent me this thing from Fox News, which was there's some chick at the Department of Energy. As I'm just finding the thing here. Who is this woman? She is the Department of one of like the heads of the Department, National Security, Special Assistant to the National Security Administration, and she's called. Get this, you people are gonna laugh at this. She's called for a queering of nuclear weapons. So what they say, because they were all against nuclear weapons, right? They're like, no, nuclear weapons are bad. But now they're saying, well, it's actually a gender issue, and they need to make nuclear weapons more about like gender neutral. And you can't make this stuff up, right?
What a waste of time and resources.
But what is the outcome? Well, what they're trying to say is it's okay for us to use nuclear weapons. It's okay that's what they're saying, but they won't acknowledge that they were wrong. They'll just try and change the terminology. They'll make it palatable to their weak, flaccid minds and make it queer. I mean, what is that? What is a queer nuclear warhead? Do they put like a pink hat on the missile? I don't.
They
I don't
paint
understand.
a rainbow. They paint a rainbow on it, and it gets to march in the parade.
So, equity and inclusion for your queer weapon. Like you go and send in a queer weapon to Iran, I don't think they're going to care whether it's queer or not. They're just going to shoot one back. So anyway, but so you
it's a clown show. It's unbelievable how Washington D.C. and a lot of these European countries, just in Canada and Western countries, just waste money on these types of programs now. I'm sure that program's getting millions of dollars for government funding for some type of research grant or something.
Mm-hmm. Yeah,
they have to do a study on it.
I've got the article in front of me. Yeah, equity and inclusion is essential for creating effective nuclear policy. An article titled "Queering Nuclear Weapons." Where do these people come from? Anyway, Xi Jinping and Putin must be laughing their asses off at this nonsense. But look, the point is that over time they will get to the point where they will take on and invest into the things that we are invested into. They will rebrand them, rename them. They will justify them in some twisted form, whether it's now, gender neutral fucking nuclear technology or whatever. It doesn't matter. They'll come up with some nonsense, and that's where the capital will flow. There's a window of opportunity to get in before that, and even when that does happen, it's not going to solve this very, very big structural deficit that we've got across the space. And it's also not going to, and we're talking about just now about the West, but you've got many, many countries around the world that are experiencing political disruption, like you just mentioned, Chile, Colombia. Like I said, what's happening in Mexico is deeply disturbing. I think Musk just put on hold his plans um, for a Tesla factory in I think it was Monterey, because he's looking at the stuff going, holy shit, maybe this is
Well,
not quite, you know,
it's not
what.
just Mexican politics. I mean, look at the cost of auto loans. The average consumer, I mean, like auto loan sales, even non-electric vehicle auto loan sales are not doing well because of the interest rates. So I think the Fed raising interest rates as quickly as they did has hurt Main Street. It's hurt small business. It's hurt the consumer more than it's hurt large corporations.
Yeah, yeah, 100%.
I want to ask you about the Fed cutting rates. Do you think that the Fed cutting rates, will it fix U.S. residential and commercial real estate?
It's a broad question. I'm not trying to skirt it, but when I think about the United States more than ever, firstly, it's not united. Okay, it's very ununited, I would suggest, and so as a consequence, real estate in different jurisdictions can and will experience completely different outcomes. I mean, California, for example, has been experiencing the biggest net outflow of individuals and businesses in its history. Not surprisingly, I mean, they just basically now, what did they get? Free healthcare to refugees, as well as zero cost, zero down and 0% interest rates on purchasing houses for refugees. If you're a tax-paying individual, then unlike you've got to go through the normal routes. These are completely insane policies. Anyway, the point is that they're going to go bankrupt as a state. The taxes are going to continue to be high and rising. They're looking at an exit tax. So all of these things are highly problematic for real estate in California. But that's not quite the same necessarily as, say, Florida. So again, it's very dependent on where you are. That's got, I think, a larger component to it than Fed cutting rates and interest rates and hence mortgage rates.
Okay, that's a fair point. I also think that there's a cash flow problem too. So even if the interest rates the Fed starts cutting 50 basis points, 75, 100 basis points, there's still a cash flow problem because these real estate investors, especially for commercial real estate, everything's on an Excel spreadsheet. It's what's our occupancy rate, what's our average monthly rent that we're charging. All those numbers are broken now. They're not getting the cash flow that they were projected with their mortgage debt to pay off their mortgage debt and make a profit.
Yeah, I mean, to I don't know this stuff really, really, really in depth, but I was chatting to a couple of guys who are huge commercial real estate investors in the US, some of the biggest, and there is still the one of the benefits that you've got in the US is, of course, is long-term debt markets, i.e., you can take out mortgages for 20, 30 years. And so structurally across the whole board, you don't quite have the same variables that you've got in other countries, which you've got, shall we say, credit markets that aren't as sort of well developed. So where you got, let's take an average, say a commercial real estate investor who's sitting on a 20-year mortgages. It doesn't really matter what the Fed does now because it doesn't affect him, right? So how much of the market is in that situation compared to how much is in the market where they've got maybe a 2-year rolling fix, and after 2 years they're going to have to go and say, okay, what does it look like now? And that can be problematic, obviously. But the US at least comparative to many other markets or any other market in the world, is a little bit unique in that your debt markets are much more deep, and you've got that longevity of mortgages. So these
It's
are all
even worse than
variables
that,
that
Chris.
can
Like post
affect.
2008, I've been speaking to Melody Wright, the real estate expert. Post 2008, I mean, Fannie and Freddie and the U.S. federal government just went in, and the banks, when they refinance those mortgages for 30 years, the banks don't hold those mortgages for a long period of time. Fannie
No,
and
they sell
Freddie
them.
end up, the U.S. federal government and Fannie and Freddie end up owning a lot of the mortgages, and the Federal Reserve Bank buys the mortgage-backed securities after Wall Street sells it for a profit. So I mean, like, this is subsidized by government, Chris, these 30-year mortgages, and they're talking about 50. There was a proposal recently for a 50-year mortgage or something. If the real estate market starts to break, they were talking about changing the mortgages to a 50-year.
Yeah, look, I mean, all you're doing is you're rolling risk. You're rolling it from maturities, one thing. And then, as you just correctly mentioned, they're just taking those securities and then on selling them. And who's the end buyer? Well, the end buyer is the government. And where's the government going to get the money from? Well, they're going to get the money from taxing individuals. So, and now you're just taking basically corporate debt, and you're moving the risk profile across to government debt. So now we're talking about a sovereign debt crisis, right? That's what you're talking about.
Yep, currency
Um,
debasement too. Yep. So yeah, the
and
financial
you go, how
repression, yield curve control, currency debasement.
what does sovereign debt crises look like, and what are the asset classes that you would want to own when you're going into or experiencing a sovereign debt crisis? These are all easy factors for people to figure out. You just go and literally just go and start reading for a weekend, and you'll come out with basically a pretty damn good portfolio to protect yourself against the inevitable. And they're inevitable. It's like this stuff isn't. It's not like it's debatable. I mean, we've the only thing that's debatable is time frame. Does it come tomorrow? Does it come in a year's time? It doesn't really matter. When you have something of such magnitude, it's a bit like saying, well, I know there's a tidal wave coming. It's like it's over there on the horizon, but I can't really, I'm not sure about how fast it's moving. It could get here in 30 minutes, but it could be 3 hours. And I'm like, well, it's coming. I mean, for starters, like pack up your deck chair and just get off the beach. That could be maybe the first step, you know?
Yeah. Why
So
try to time it perfectly? Yeah, that's your point, right? Why try to time it exactly perfectly? Try to get out of all your NVIDIA tech stocks at the perfect timing, get into gold at the bottom. I mean, Stanley Druckenmiller was selling NVIDIA, months ago, and he was buying gold miners, I think, towards the bottom. If you would have told me 12 months ago, Chris, when the gold price was below 2000, I think it was like 1800, that the gold price would hit 2500 so quickly, I would have been pretty surprised. It would have went up, another $600 an ounce. What do you think is the probability that we get to $3,000 an ounce gold in 18 months or less at this point?
I don't really like making predictions around price, because there are actually so many variables that can come into it, i.e., how much a government can inflate, whether they go to war or not. There's a million different variables that can affect that price. But what I do pay attention to is trend and fundamentals. The fundamentals are very, very favorable for precious metals, gold in particular. And the trend is like we're just broken out. It's weird, we broke highs, we keep breaking highs, and still retail's not invested. Not only is retail not invested, commercials aren't even invested. I mean, this is basically at the moment pretty much a central bank trade. And
Yeah, in
and
Asia.
so
Yeah, in Asia.
in Asia, exactly. And so, you're watching this shift of capital from west to east. Um, there will be catch up with respect to the equities because inevitably that's what happens. But again, the equities are very different. You own the equities for a completely different reason as to why you would own physical gold. But that being said, that is, I think, one of the most underrated trades that exists out there is, and it's a simple one. Anyone can put it on. It's brain dead simple. So, um, any geopolitical, um, any time in history where we've gone through global conflict, just go. That's what I would suggest people go and have a look at and see what asset classes do what. Gold is one of them. Energy is a huge one. There's many other ones, but that's where you need to be invested, in my opinion. And not only do you need to be invested there, these are still some of the cheapest sectors across the whole board. Like if people don't realize, if you're buying the Nasdaq or the S&P, you're basically buying the Mag 7. So the largest percentage of those indices relative to any time in history, the percentage is higher than we had in the dot-com era, when you had like Cisco and all the tech companies that were represented a very high portion of the S&P 500. And today we're even more egregious than that with respect to the Mag 7. So I don't know when it ends, but what I do know is that most people invested into what they think is a broad equity index, i.e. the S&P, don't understand that their risk profile has changed.
Do you also think that that this paradigm shift over the last 2 years since the Russia sanctions is accelerated because central banks were buying gold each month, especially outside the G7 prior to the Russia sanctions? But I think the amount of tonnage purchases, the monthly tonnage purchases, is almost double. I think each month the average is up almost double according to the World Gold Council post Russia sanctions. So do you think that this is like a new paradigm where these non-G7 central banks are deciding we don't like the spending projections that both political parties in DC are on? We're not going to be recycling into US Treasuries anymore. We're diversifying away from Treasuries now.
100%. Yeah. That's the obvious. I mean, what would you do?
I would buy whatever commodities are cheap. I think the Chinese have a pretty good strategy.
If you were a government, I wrote about it. The moment that the US sanctioned or froze or stole, or whatever, choose your terminology, then when they stole their reserves, it wasn't even so much that they could do it to a nuclear power in Russia, which is a fairly significant country in its own right. It's that they told the rest of the world what to do, and the rest of the world was told, they were put on notice. In their hubris, they thought that it would bow them, and it didn't. Instead, they all went, oh shit, we need a plan B. How about instead of taking all these treasuries that we own, that we've been earning, how about we just use something, put them somewhere else, right? And so we've seen that shift accelerating. And then, of course, with respect to the actually underlying technology and shift of utilization of banking measures, all of those things have been underway as a consequence. So they let the cat out of the bag there, and they kicked off basically a global arms race with respect to financial infrastructure, and so that's coming for sure. The irony behind it is that as you go through that process, it's likely to be relatively dollar bullish. And I say that simply because much of the credit in the world is dollars. And if you've got to get out of your dollars and use a different currency as well as a different infrastructure, then you're going to see a decline in the use of dollars, but that also means paying back the credit, the debt, and that's actually bullish for the dollar. So anyway, that's a different story. I don't think it's worth actually trying to figure out what happens in currency markets. I think they're all shit, and you don't actually need to play that game just yet. There will be some new currency that comes along that will be utilized as a dominant currency in maybe a decade. But between now and then, you basically buy the underlying assets that are likely going to underpin it. And they're the cheapest they've pretty much ever been. So it's an easy trade.
Okay, so no dollar collapse because you're saying because of all this dollar denominated debt that was borrowed by foreign corporations and foreign governments outside the US since 2008. So when the dollar was weaker, these other governments and corporations outside the United States, all borrowed enormous amounts of dollar denominated debt over the last 15 years. And you're saying that creates demand for dollars. So the dollar won't collapse, but it will be.
You got to pay back your debt. It's
Yes.
like if I lent you money and I lent it in dollars, and you got your that's the trade, and you're like, damn it, I don't want to pay. I don't want this anymore. I want to shift some of that to whatever else, or I'm going to pay some of it down. Well, you have to get the dollars to pay it down. So it's a bullish trade. It's bullish on the dollar.
Well, the other part of it, and our mutual friend George Gvmnt, I mean, he went on a trip through Argentina. So a lot of people in emerging markets, they still view the dollar on a relative basis as a safer bet to store savings because they either want to move to the US or they want to save outside of their own domestic currency. So it's all like a relative game. So if the Argentinian peso, given its history with all the hyperinflations, a lot of Argentinians want to save in dollars compared to Argentinian pesos then.
Yeah.
So that's creating a higher floor, a higher demand for dollars. So the dollar won't collapse overnight. I mean, it will be debased, but then that just gives the brainwashed people who think they're geniuses here in Washington, D.C. an excuse to do even more crazy stuff with the policies and debase the currency.
I'm not sure at this point that a lot of these policy measures matter. Like I watch people looking at what the Fed's going to do with interest rates or what these numbers are for unemployment numbers, all these sorts of things. If you go and you just look at broad trends, global trends underway, and you go back over history, a lot of these things are important from a trading perspective in the short term, i.e., months, maybe for a year or two. But the overall massive trends unfolding, it doesn't affect them at all. Like it's got zero effect on them, and it doesn't make sense. It's a bit like, it doesn't matter what the Fed does with rates. No, they're bankrupt. The the U.S. government is bankrupt. They're going into fighting wars on behalf of Israel now, and fighting a war utilizing proxies against Russia, antagonizing China in the South China Seas. I mean, these are all very expensive endeavors. They're collapsing their own domestic and have collapsed their own domestic production base largely and outsourced it to Asia. These things are not easily reversible. What I would suggest they're not reversible at this point, especially given the massive debt load. So, like, it doesn't matter what the Fed does. I mean, like a raise, drop, like, there's no real meaningful impact on these large things unfolding. And so,
Well,
we're in for a period of stagflation, in my opinion. And you might as well get ready for it, and position for it.
Well, I also think the Fed raising interest rates at that high a pace, I think it hurt Main Street. It hurt the regular consumer, the middle class person, small businesses, and it hurt a lot of banks, private banks, so Japanese banks, European banks outside the United States, and in the regional banks. So I think there are banking system problems. I think it's mostly with foreign banks with like older treasury bonds, dollar denominated debt. So I think there will be problems in the banking system. And the Fed's just created even more distortions because there shouldn't be all these PhD economists and bureaucrats making decisions with things as important as interest rates for cost of capital.
Yep, can't disagree there.
Well, I think that these policies, Chris, they just lead to more misallocations of capital, distortions, and stagflation, like you said. And then that's when we get like these Main Street businesses are failing, but then small business owners keep telling me, well, my insurance costs are going up and all these other input costs are rising, labor costs, all these things are still going up.
Mm. Yeah. Doesn't change it, mate.
Well, look at this is back to the supply side on commodities, Chris. Look at the cost to build a medium-sized copper mine. It's at least $1 billion now, and you're looking at 10 years or more to get all the permits, depending upon the country outside of Africa, to get all the permits and then to build the mine. It takes a lot of time and a lot of capital.
And pray tell, who is actually going to finance that when you such geopolitical risk?
Can the banks? I think some of the banks, Chris, aren't even allowed to. So some of the banks have like
they got all these bloody ESG policies where they go, oh, you've reached your threshold in terms of, carbon emission investments and all this garbage.
But how are you going to have electric vehicles without copper?
It's just unbelievably stupid. But again, look, it's easy when your house is on fire, it's easy to fixate on the flames. But I think it's a stressful situation to be in, and it's not particularly productive. What is, in my opinion, a better thing to do is to control what you can within your own sphere of influence. And one of the things that we can control, because we don't have ESG policies placed on us, is that we can watch and see what they're doing, and adjust accordingly. I mean, that's what you literally have to protect yourself.
Well, also like the ESG lobbyists, the ones that are on TV and like in the press here in Washington, D.C., or on the corporate media promoting like green energy and ESG policies, a lot of them for their own kids and themselves, they don't even drive the electric vehicles or the hybrids. So I mean, I see McLarens around here 20 minutes outside of Washington, D.C., in the neighborhoods where the ESG lobbyists live and the heads of like these government agencies. They're driving like over $100,000 sports cars and gas guzzling like Range Rovers.
Yeah, yeah. No, it's unbelievable. I mean, where I'm, one of the places I got in New Zealand here, which I'm at the moment, like, I bought in a sports car, which is a gas guzzler, basically. um, and I imported the thing, but I realized when I was bringing it in, I literally managed to do it within a 2 week window where they've got some new policy where you actually can't import them, right? Because they don't meet. It's like they have these emissions standards, and they're like, oh, we're not going to import those anymore. So what you're going to see in a place like and this is not just New Zealand, which is woke and retarded, is that over the course of time, you're not going to have decent vehicles on the road. We're going to have all these nonsense, ridiculous things. Um, Now, that would probably put a premium on the ones that do exist, right? Because you can't get them anymore. But it's a decline of society. It's a massive decline of society, and uh, yeah, um, this is it's just insanity across the board. But again, you can fixate on the flames, or you can actually try and do something about it with what is within your own control, and that's what I intend to do and what I do.
Yeah, I agree. I mean, investing in conventional energy, so nuclear power, coal, oil, natural gas, these things are important long term, especially because like all the tech companies, the big tech companies, so Amazon and Google and Meta, and what the other one, I can't remember all of them off the top of my head, but they're all investing like they want to set up artificial intelligence, but first they have to build the data centers. And these data centers, the next generation ones, Chris, are like an order of magnitude more electricity requirements than the current ones for Netflix and YouTube.
Yep. Yep. I mean, you don't even need to look at the names. You can just look at valuations. Why would you buy a company that's like 80 times PE? Like you have to have a very, very compelling reason why that would make sense, right?
Well, you and me look
Um,
at cash flow and fundamentals and value investing. I mean, there's a lot of people that just day trade and look at a chart.
hmm Which is fine. Then you're a trader. That's cool. But traders, like, I mean, I know some traders, some excellent traders. That there's nothing they don't care about the underlying, and it doesn't matter. It's like years ago I used to trade currencies. Like you wouldn't care whether the currency was good or bad. You were simply just using momentum and a whole bunch of other stochastics, and that was it. Like you didn't give a flying fig if it if it was going one way or the other. Like you just all you wanted was a certain level of volatility within certain bands, so that you could you could enter and exit with a few points and just keep doing that to make money. So if you're a trader and you're just like playing momentum on the stuff, fine. And traders that know what they're doing will be fine. They won't get caught. Um, they'll maybe get stopped out on something like, oh, lost a bit of money. But the people who are going to get caught are the people who are actually investing in the stuff, because you can't invest into something that is so outrageously expensive and doesn't make any sense. So that's not an investment, that's a speculation. So you're either speculating or you're trading. If you're trading, that's cool, you know what you're doing. If you're speculating, well, you're taking a lot of risk. And now you need to determine how much risk you've got there. Like, what's your position size on that thing? And that's why I talked about the S&P 500. I mean, over 30% of the S&P is basically in the Mag 7. If you got like 30% weighting, and trust me, when the Mag 7 goes down, all of that other shit goes down. Why? Because everyone's going to throw the baby out with the bathwater. So at that point, you might have some very fantastic setups of companies that are actually become worth buying. But the moment, nah, dangerous. So
I want to thank you so much for your time today, Chris. If my listeners want to check out your newsletter over at Capitalist Exploits, how did they do so?
Just go to capitalistexploits.at. That's our website for the publication, and then for institutional, or shall we say, accredited investors, our asset management company is glenorchycapital.net.